Okay, so forgive me, okay, this is how it goes. So I'll read my remarks so I don't lose my train of thought or forget to say something important. So good afternoon and welcome. The title of my presentation today is Commodity Prices Matter. But before I get into the subject matter, let me briefly introduce myself. So I'm an author, a hedge fund publisher, investment advisor, and a former oil trader and hedge fund manager. I'm also a contributing editor at Zero Hedge. In 2020, I founded my own company, Krainer Analytics. I have 2 active publications on Substack with about 35,000 subscribers. One of them is called iSystem Trend Compass, and the other one is Alex Krainer's Substack. Over the years, I've published 3 books. My first title, Mastering Uncertainty in Commodities Trading, was ranked #1 book on financialexpert.co.uk list of the 5 best commodity books for investors and traders for 2021 and 2022. So, why do commodity prices matter? Let's go back about 100 years. In 1921, Chicago economist Frank Knight published Risk, Uncertainty, and Profit. The book is widely considered to be one of the 5 most important economics texts of the 20th century. As a central part of his thesis, Knight makes the critical distinction between the concept of risk and uncertainty. His argument was that in competitive markets, only true uncertainty can be the basis of a firm's ability to earn positive economic profits on a sustainable basis. The key aspect of uncertainty is price, which Knight regarded as the most important factor in determining firms' profitability. So, quote, "The most important fundamental determining fact in connection with organization is the meeting of uncertainty. The responsible decisions in organized economic life are price decisions. Others can be reduced to routine." This may be more true today than when Knight wrote it. Over the last 20 years, extreme price events have become much more prevalent than in the past, and commodity-related businesses operate in an environment that's riskier than ever. Large-scale price events represent the greatest source of risk for commodity firms. None of this is news, but what's important to recognize is also that large-scale price events could be the greatest source of opportunity as well. So we'll have a look at 3 different cases underscoring the heavy impact of price on profitability of commodity producers. From 2003 to 2010, AngloGold Ashanti, at that time the world's third largest gold mining company, accumulated $2.41 billion in losses by hedging its exposure to the price of gold. Their hedge locked the firm into forward gold sales at below $450 per ounce during the time when the gold price rose more than 3-fold, reaching $1,400 in 2010. In 2013, Barrick Gold, the world's largest gold mining corporation, posted a quarterly net loss of $8.6 billion when gold prices crashed $500 per ounce from nearly $1,700 to just over $1,200. Barrick Gold's error was the opposite of AngloGold Ashanti's. They did not hedge their exposure and consequently suffered when the price of gold collapsed. These gold mining firms' cases were severe, but they were not exceptions. Almost daily, the financial press publishes stories about firms reporting either windfall profits or losses because of changes in commodity prices or currency rates. The next example, however, provides an industry-wide case study reaffirming this principle, and it concerns the mining industry. From mid-2014 through 2015, commodity prices collapsed by over 50%, as the Goldman Sachs Commodity Index here illustrates. The decline was disastrous for the North American mining industry, resulting in a total after-tax loss of $227 billion for 2015. These losses wiped more than 8 years worth of industry's profit. This is truly an unforgiving risk environment. Clearly, commodity risk can and does have massive impact on companies' profits and shareholder value. As the cases we just looked at clearly show, the risk derives from large-scale price events, which appear to have become more severe and more frequent in recent years, making commodity price risk more pronounced than it has been in the past. Take the oil market. Measured by historical standards, the price of oil has been extremely volatile in recent years, from over $114 per barrel in the summer of 2014. It collapsed more than 75% in only 18 months' time. Then it tripled to $86 per barrel in October 2018, only to drop by 40% to $52 2 months later. Predictably, this roller coaster caused a good deal of pain for many industry participants. For instance, in late March 2019, China's top refiner Sinopec disclosed that it had incurred $690 million in losses that were attributed to the hedging transactions under Sinopec's trading unit, Unipec. Unipec took the wrong directional exposure to oil prices, and their losses led to a 90% decline in Sinopec's overall profitability. A month later, in April 2019, one of the world's biggest oil traders, Trafigura, reported losing $254 million from oil and gas hedging. In April 2020, coinciding with the 65% drop in oil prices, Ryanair lost $325 million on their hedging, Hinleong lost $3.8 billion, Vitol lost $1.6 billion, ABN AMRO Bank $1.4 billion, and in the United States, 25 independent oil producers filed for bankruptcy. In August 2022, coinciding with that last price drop in this chart, US shale oil producers collectively sustained over $10 billion in hedging losses. Indeed, over the last 15 years or so, deepening global economic and political uncertainties have had a dramatic impact on many commodity markets. The liberal money printing by central banks hasn't helped either, and more of that is on its way. The changes are plainly visible in the long-term price trajectories as illustrated in this chart. Since about 2005, many commodity markets have experienced a dramatic increase in price volatility and frequency of large-scale price events. This is making commodity-related firms much more vulnerable to risk than ever before. Empirical data confirms this. For example, Boston Consulting Group made an analysis of 35,000 companies from 1950 to 2015. Their study shows the effects of these changes on firms today. For example, from 1965 to 2015, the average lifespan of a public US company declined from 55 years to only 31 years. The percentage of public firms exiting each year quadrupled from 2.5% to 10%. And the 5-year exit risk for such firms has exploded from 5% in 1965 to 32% in 2015. What these statistics suggest is that the increasingly intense competitive environment, together with greater price volatility, has greatly exacerbated the risk environment, especially for commodity-related businesses. Business as usual is more risky than ever for companies today, and price risk is certainly the main risk factor. Leaving the problem to chance or tackling it with half measures is no longer justifiable. Nearly 90% of managers in commodity-related businesses view commodity risk management as a key source of competitive advantage. The question is, how should firms adapt to cope with the challenges ahead? In tackling these challenges, it is important to recognize that risk is the flip side of opportunity. If price exposure is the greatest source of risk, the same could be the most powerful driver of value creation. It follows that managers in commodity firms should take active steps to explore strategically sound solutions to respond to the new competitive environment in a way that could enhance their firm's profitability and resilience. These steps should take two related problem areas into consideration. First, the ability to nimbly respond to market price fluctuations, and second, in making organizational adjustments to integrate price risk management with the firm's core activities in a way that's robust and transparent. I'll discuss each challenge in turn. Returning to the Frank Knight quote we saw earlier, price decisions are probably the most important ones in the life of a business. At the same time, price decisions are probably the most difficult ones for managers to master because ultimately they involve speculation. Over the years, I've spoken to many industry executives about this problem. While most of them had a keen interest in hedging the price risk, few were comfortable enough to actually tackle the challenge head on. The refrain that I kept hearing was, "Yes, but we do not wish to speculate." What the managers usually wanted was some way to sidestep the risk by removing the possibility of large losses while keeping some exposure to favorable price changes. While this is technically achievable, the cost of this type of headache-free hedging can be prohibitively high and ultimately unfeasible. Managers' reluctance to get their hands dirty with hedging is often the result of a skill gap between what is required to run a business operation and what is needed to speculate in commodities markets. Operating firms select for skills that support its core operations like production, marketing, sales, or finance. By contrast, hedging requires totally different skill set related to market speculation, and these are not normally cultivated in operative businesses. As a result, managers usually regard hedging with reserve, and firms tend to manage their commodity price risk either passively or in some crude form. Given everything that can go wrong with speculation, this cautious stance is understandable. At the very least, it enables companies to perform broadly in line with their competitors, but unfortunately, that is all that it will do. The passive approach will not enable outperformance or competitive edge that could be achieved with an effective solution to the problem of price risk. As Thomas Aquinas put it, if the highest aim of a captain were to preserve his ship, he would keep it in port forever. Of course, people do not build ships to preserve them, they build them for profitable enterprise. Likewise, managers should not run their businesses just to avoid risk, especially where risk, if adequately managed, has such strong profit potential. That is clearly the case with price hedging. In light of what we've seen so far about the relationship between commodity price and business profitability, it follows that such potential should be, at the very least, made a priority issue to explore at any commodity-related company. Skillful hedging can facilitate significant competitive advantages. For instance, if the prices of key inputs are rising, a company can secure lower cost of materials by buying adequate quantities for future delivery. Conversely, if the selling prices are falling, the firm can fix higher prices by taking short positions in the futures markets. In this way, hedging can significantly improve operating profits. Based on the income statements of an average S&P 1500 company, a 1% improvement in the selling price would generate an 8% improvement in operating profits. Conversely, a 1% drop in cost of goods sold would lead to a 5.36% increase in operating profits. This impact is more than double that of a 1% increase in sales volumes. For commodities businesses where operating margins are typically very low, hedging can provide a much greater impact. It can also provide the most powerful way for companies to differentiate themselves from competitors and gain difficult-to-match advantage over them. Consider the example of U.S. petroleum wholesale industry where the operating margins averaged at about 0.8%. This is based on a first research survey of nearly 14,000 companies engaged in the petroleum wholesale business. At a cost of around $800 per metric ton of heating oil, a typical wholesaler could hope to earn a profit of about $6.4 per ton. But suppose they were able to reduce their cost of merchandise by an average of 1%. A 1% improvement in the purchase price would add $8 per metric ton to the firm's profit margin, raising it from $6.40 to $14.40, which is a 125% improvement in operating profits. Given such dramatic value potential, managers can Managers at commodity firms should consider upgrading their hedging operations and implementing a controlled, systematic approach to speculation. After all, taking risks is what firms must do to generate profits. Of course, the key question is whether achieving and sustaining this kind of competitive advantage is realistic. It is not realistic to expect that hedging can achieve either a permanently reduced cost of goods sold or permanently higher selling prices. However, at times when commodity prices undergo large-scale price events, gaining a definitive and significant price advantage through hedging is entirely realistic. The next question then is, how should firms go about exploiting this potential advantage? Quality answers, I believe, would not fail to emerge through a systematic approach to problem solving and some organizational engineering. Well, there's that. A purposeful, effective approach to managing uncertainty and risk requires an adequate organizational framework. For any organization, the question of what risks are taken, in what measure, and how they are managed are strategic questions that must be decided at the board level. The implementation of these decisions must be owned by the firm's CEO. An effective hedging process should enable a firm to take risks in a controlled and purposeful fashion, accept occasional losses, and communicate such losses to its shareholders openly and transparently without losing their confidence in the validity of the firm's strategic choices or the management's ability to achieve them. Without clarity and guidance from the company's board and the CEO, the firm might be vulnerable to severe risk disruptions, or it might fail to take advantage of favorable market events. Running a formal audit of key risk areas should form the foundation of a firm's risk management process. For each category of risk, alternative instruments of methods of risk management should be identified and their respective advantages and disadvantages thoroughly examined and documented. After evaluating the pros and cons of the available alternatives, management can formulate specific objectives and strategies to pursue in achieving these goals. Definitive risk strategies should set forth the company's methods and its appetite for risk. Managers should also explicitly set out the responsibilities for risk management throughout the organization. At that point, they should anticipate the necessary organizational adjustments like training and staffing requirements. The whole process and the organization that supports it should be thoroughly documented. Finally, the solution will almost certainly need adjustments and maintenance, so constant monitoring and periodic reviews must remain an integral part of a firm's risk management strategy. For that purpose, the firms must establish an independent middle office staffed with a team of skilled risk professionals who regularly report on exposure and risk issues directly to the senior management and the CEO. When it comes to hedging, firms do not need to bet the proverbial ranch. At first, they can apply the process only to a smaller portion of their exposure, say 5 or 10% of their hedging requirements, and then increase it incrementally as the firm, its staff, and stakeholders grow more familiar and comfortable with the process and its impact on the firm's performance. For that to happen, the communications aspect of the process must be as important as operational execution. All parties involved should be offered the opportunity to question and understand the process and be periodically kept informed about its progress and results. So that's the dry part. The challenge of developing and implementing this business process should not be any more difficult than that of developing any other business project. However, its objectives and their potential gains in terms of profitability and competitive advantage should be well worth the manager's effort. Regardless of all other aspects of their business operation, experience and empirical evidence strongly support the idea that responsible decisions in organized economic life are price decisions. As such, hedging price risk should be a high priority challenge for managers in commodity-related businesses. Beyond profitability, it can render a company much more resilient in turbulent times, and it can substantially boost its lifespan. And before concluding my remarks, I'm always reminded, I want to share my contact details in case anyone had questions about what I presented here. My X account, email, website. The books I mentioned are available as free downloads because I got completely canceled by Amazon, so they cannot be purchased at all. And my telephone number is there. So every claim I made in this presentation is backed up with sources and references, and the thesis was published in the peer-reviewed Journal of Corporate Accounting and Finance. The title is Commodity Price Risk, Profits and Value Creation. So the relevance for investors is companies that are, let's say, miners, gold, silver, and so forth. They might end up very profitable unless they hedge their exposure to favorable price events. And for managers, obviously, this is a problem matter that needs to be addressed and explored. That's all for me today, so thank you very much for your patience and interest.
We're going to take questions?
Yeah.
Perfect. No, Alex, thank you so much. And
just one question. Will KI or AI help us to manage these kind of risks in a more smooth way?
My experience is no. So I have myself developed a form of AI exactly for this purpose. So to speak metaphorically, it's like a big machine that generates buy and sell decisions in a real time. And then when AI came along and people started talking about AI, I tested it, and it's not. What AI can do is it can generate algorithms. You can tell it, I want this kind of an algorithm to, let's say, trade gold or hedge silver prices or whatever. And then AI will do it, and it will maybe do a decent job of it even. But the problem is that it's your job then to implement that. So AI will spit out an algorithm, then you have to ask yourself, that's exactly the problem that I've been facing in my career. What do I expect from this algorithm? Obviously it would have worked if implemented in the past. Will it work in the future? And AI cannot help you with that at all. And the problem with AI is it's an even bigger machine that's made to be all things to all people, meaning you can ask it anywhere, anything, and it can do many things. You really want a machine that's built, it would be like asking a robot that can do anything to open your beer bottle. It's much simpler to have a beer bottle opener, right? So you can train the other one to do it, but it's going to be kind of expensive in terms of resources, and the other one is much faster and much reliable. That's, I think, metaphorically the best explanation I can give you of my experience with both.
do you have any more questions for Alex?
And AI robot is not paying taxes.
Well, AI robot doesn't make, how do you call it, capital gains. You know.
Who's paying the taxes now?
Well, you are if you make capital gains, and AI companies.
All are sitting at home because the robot is doing all the work. Nobody pays taxes.
I think that all these visions and ideas are maybe extrapolated into the future a bit too optimistically. One thing that AI cannot do, because I've gone very deep into AI research, because I started building my models back in the late 1990s. And one thing that AI cannot do, and it will never able to do, I can put my name on this and we can take it back. AI cannot generate hypotheses. AI can take a lot of knowledge that's out there and then find reasonable answers to questions, but they cannot generate their own knowledge. They cannot generate their own hypotheses. When we face a problem and we don't know what it is and we don't know how to solve it, we almost innately in our mind generate hypotheses. Aha, this is like this because maybe it's this, or maybe it's this, or maybe it's that. And that happens automatically on autopilot practically all the time, subconsciously. Like the way your vision resolves problems of, I have to walk over that, now it's downhill, now it's uphill. That's really intelligence at work. That's not just film going into the eyes and then into the brains and it's easy. It's not mechanical, it's extremely complex. AI cannot do that at all. You have to program it. And one of the best examples that I've come across from this is I watched a Tesla interpret what's in front of it, which is fascinating because all you see is a screen with a black and white silhouette of what it thinks is in front of it. And then the Tesla comes behind a stagecoach. So there's a big black box and horses in front. And so it sees the big black box and some legs moving. And so what happens next is starts flipping between it's a truck and it's a pedestrian. So on the black silhouette on the screen, it shows a man, and then it shows a big Mack truck, and then goes back to the man. Why? Because when they programmed this system's knowledge-based, nobody thought about stagecoaches. And the system itself cannot come to the conclusion, oh, look, that's a horse, and there's some big black box behind it. It doesn't know that such a thing exists. You have to actually program it in. You have to describe the stagecoach, and then you have to make, if the thing matches this description, then it's a stagecoach, and then on the screen it will be able to show you. But the AI, it will never be able to come up with those answers itself. They have to be hardwired. They have to be programmed in.
So it stays like extra help.
I'm sorry?
So it remains extra help.
Yeah, and it's very helpful. I think you have to use it carefully because it's usually helpful in conventional ways. In the sense that if you ask for if you ask a question, you'll get the conventional answer. So like if you ask how did World War I start, it will tell you the story you learned in school.
Because it's history.
Yeah, and I've been discovering that everything they taught us in school about history isn't exactly the truth.
But then you have quantum computing, computers coming, and they are
Well,
faster in calculating.
I think same thing. It'll be a lot more powerful, but it will still not be able to generate its own hypothesis.
Yeah, but it's a danger for the crypto market, I think, because it can crack the Bitcoin code in seconds.
Maybe. I wouldn't know.
It won't create gold.
Okay?
Will it?
You can change it, of course, and hold it.
As far as I know, alchemy doesn't work, so we'll find out.
Unless you own a bank. Unless you own a bank, then it does.
Exactly. I don't even know.
I think there was a question in the back.
All the way in the back.
Yeah.
Thank you very much. Question about attacking, for example, Mr. Neumeier, he told that his assumption is that megatech will owe mining companies, which are important to them, or for the commodities, and at the moment they're using so much cash flow for the AI. And you say that there will be limits to AI which will become apparent. For example, for so-called finance people who think they can outmaneuver or they can profit, so to speak, from bad hedging.
Yeah.
How will it fit? I mean, that would the price of commodity be at all of interest to the megatech companies who need they simply need commodities? Will there be the position to get sort of monopolies over commodities? Because if mining companies, like you said, like you showed, they have made horrendous losses by bad hedging.
Well, I think when it comes to...
They will simply gobble up everything.
I think that, unless I'm misunderstanding the question, I think that the megatech companies won't be that impacted because the commodity inputs are relatively a small part of their business model. So maybe it marginally increases the cost of their chips and so on, but the biggest chunk of the cost of chips is profit margins by far. And materials they go in, they're not that important. I think that the biggest impact will be on the mining companies themselves. And then there's a lot of things that are changing let's say the riskiness and volatility of commodity prices, geopolitical uncertainties, but I think also the banks just printing money because, when we talk about the price of gold, price of silver, price of this and that, it's always so many dollars per something else. So that dollar is, for example, one thing that I discovered in my oil trading career is that up until I think 2018 or 2019, the correlation between the price of crude oil and US dollar was 80% inverse. So when dollar was gaining strength, oil prices were collapsing. And when dollar was losing strength, oil prices were going up. And this relationship held for over 20 years. So 80% correlation means that the relative strength of the dollar is by far the strongest factor influencing oil prices. And we're not even talking about supply, demand, whether economy is growing or shrinking or production or discoveries, exploration, none of that. All of that is 20%. The dollar is 80%. So that means that if you want to figure out what's going to happen, you have to go and look at the American economy, inflation, GDP growth, employment, all of those things. So it's, the relationships between what might seem like causal factors to us when you read the press and you see this is happening and that is happening. It's much more complex than that. It's not mechanical. You can almost think of it like a blob, like an amoeba that's kind of moving, and you think when something happens that it will go that way, but maybe it'll just do something else. And after almost 30 years in commodity markets, that I'm an active participant in commodity markets to this day, I can't figure it out. So I honestly, I think just the other day I published an article called Fundamentals Analysis, a complete and total waste of time. Like reading, I genuinely believe that. I'm not even making fun.
What should a small investor do? How to survive?
Trends, go with trends. If something's going up, buy it. If it's going down, don't buy it or sell it short. Honestly. My newsletter is called iSystem Trend Following. So that's what I do. That's the best answer I ever found. Because honestly, very often, even if in one of the books, you can download those books for free, and it's not because they're crap, but because Amazon canceled me. I go through forecasting. Billions, tens of billions of dollars every year are being spent by research institutions, institutes that all they ever do is they just analyze markets, supply, demand, capital investments, everything you can name, all the data that's being generated in the world, they put it in their models and then they say, oh, this is going to happen. And they're right about half the time, and then the other half the time they're wrong, which means that you can do as well by flipping coin. No, sorry, you can do better by flipping coin because they are a little bit below 50%. So there's a company that actually tracked these analysts and their forecasts for a long period of time, and they came to the conclusion that their success rate is, I think, about 49%. So if you flip a coin, you already have an advantage over them.
If you look at the current oil to gold ratio,
I have no idea what it is.
would you follow the trend of oil going down? I can tell
Ooh,
you
that's hard. Yes, that's yes. Look,
at the moment it's on the historical almost
downtrend. Yes,
downtrend. So
yes.
it was never, almost never, except of COVID, that it was possible to buy so many barrels of oil for 1 ounce of gold. Okay?
Oh yes, yes, yes. In that sense, yes, I agree.
So would you go in this direction that oil is going down?
At this moment, I wouldn't, because it's an old signal. Let's say we've had signals to go long oil, to go long gold, and to go short oil, but that happened months ago, many months ago, and I am personally, I'm kind of afraid of events in the Caribbean Sea and in Venezuela, and in the Middle East. So usually what happens with trends is they advance very gradually, and then they correct sometimes in a very brutal fashion. So you have this and then that. So to take that trade today, I think would be too risky. I would rather let it go. But months ago, absolutely, you were right. Oil is in some kind of a secular downtrend, and gold is obviously in a very, very strong uptrend. And so that is correct what you say. It's just also, the timing of making the trade is also very relevant.
Fantastic. Alex, wonderful. Thank you so much.
Thank you.
I really,
Thank you
really
very much.
appreciate your time. And, got a little something for you as well.
No, you are joking.